I have so much stuff I want to talk to Chris about, mainly because this guy never wants to talk on the channel ever.
I'm just
So
really busy.
no, I'm aware. You have like 20 kids,
I'm
but
sorry.
you volunteer and you take care of animals and at animal shelters. I mean, you're a perfect
That's not
guy,
true.
the perfect family.
Chris, what's something you do that's like not good?
Nothing particularly comes to mind. I'm a pretty average guy.
Oh, I'm a pretty perfect guy. Yeah, nothing
No,
comes
I'm
to
not
mind.
perfect at all, but like I try to do my best to be a good person. Anyway,
He has one
I
light
can be
beer
very-
on a weekend.
Actually, no, I don't drink at all. But like,
There we go. You
Yeah,
you
that's
have all the characteristics of
definitely
Doug's comment.
serial killer vibes.
I just saying, like, hello everybody. We are live. Let's start off with my tweet of the week, and then we'll get into all the fun stuff. I was live last night, and I just casually said it. I think SoFi will 5x before Palantir. That's what I said. I stick by that. I stand by it. I love Palantir deeply, but I think SoFi is a quicker 5x. Can you guys either agree or disagree? And if you agree, what is your reasoning for why you think that might be the case?
I think Palantir is fundamentally more misunderstood than SoFi is. SoFi is misunderstood, granted, but that is changing very rapidly with the consolidation, the synergies between their tech and their consumer platform, especially now that they've rolled out, SoFi Plus options and they're making UI updates as well. Like, I just think it's going to be a super quick exponential curve of awareness for them. And I mean, we're going to talk all about awareness in this episode of SoFi as well. The interesting thing will be sustainability of that 5x.
I disagree with you guys. I think Palantir is going to 5x way sooner. If you kind of think of what SoFi is trying to do for banking, for other banks in general, they're basically trying to do what Palantir has already done and just make infrastructure. And SoFi is really far behind. And as somebody that's had the app since August of 2021, it's kind of agonizing because there's been very few updates. Even though SoFi's claim to fame is going to be its back-end AWS model, I think a lot of investors are going to figure out who SoFi is because of their front end.
I think it's definitely SoFi, and just purely from a market cap basis. You're going to have to find a lot of new money to go and buy Palantir to make it 5x. That's roughly a $42 position at that point. That's steep for Palantir.
SoFi's $5 billion. It would have to get to 25. Palantir at 14 would have to get to 70 billion.
Both stocks are comparable in the fact that they topped out their all-time highs around 4x. Coincidentally, both of them in the end of January 2021. So it's a macro thing. Palantir on January 29th topped out at $35. It's now 8. So about 4.5x ish. Whereas SoFi topped out at $25 end of January 2021. And it's now 6.5. So around 4x ish for both of them was their all-time high 2 years ago this time.
In similar fashion, almost the exact same amount of institutional holdings. I mean, they are kind of comparable in a way.
They also don't have 2 billion
a better
shares.
total addressable market.
Well, I know that SoFi has very aggressive internal timelines to get to that 5x. Their tranches are basically unlocked, at least the first tranche. Does Palantir have a similar incentive structure for their leadership?
Palantir doesn't have shit, bro. Palantir doesn't have class shares, and we all just trust in Carpentier that'll get the job done. I do disagree that their TAM is gigantically bigger than SoFi's TAM, but SoFi doesn't have 2 billion shares.
Who knows, right? I guess if you hold both of them, maybe that's your way to the finish line. But yeah. I'm definitely a believer in SoFi. Not only SoFi though, just financial companies in general. Finances for the longest time. There's a reason why Warren Buffett holds, the largest portion of his overall portfolio, just diversified through financials, aside from just holding Apple. They're just money-making machines. Palantir has to continuously innovate. I don't think that's the same for SoFi.
Right. I do think there is something to be said about the life cycle of where these businesses are, because the reason why the likes of Warren Buffett and a lot of these hedge fund managers like finance is because it's stable, it has a good dividend, and it's a cash flow machine, because large financial institutions have so far never really had to significantly innovate their model. They can just churn more and more. Whereas with SoFi, they still have to, in a large part, prove themselves out through innovation, similarly to Palantir. So in my mind, I don't really see it as like a finance play today. In 2 years or 5 years, it can be a finance play where it right now it's in the exploration phase of that explore exploit model. In 5 years, it will have found its niche. It will be a cash flow machine, and it'll be completely exploiting its value proposition and its moat. Whereas today it's more comparable to a pure tech play that relies on innovation to build that moat out in the first place.
There's still those finance ideas, like they have the expertise to actually have a good return on equity and, you know, build it out similar to a bank versus Palantir. That's the thing that scares me the most. I stop buying the SPACs and gold and all these alternative, you know, investments. You know what I mean? All it's doing is hurting the company, or even the way institutions look at it. If you have steady financials, you're letting the brand grow just naturally, which probably a great transition.
Yeah, so this is some news that was pretty big in the SoFi world. The Weeknd is objectively the biggest artist in the world right now, averaging more than 100 million streams a month on Spotify, the first artist in the world to do this. I think 3 or 4 of his songs hit 1 billion streams over the past couple of months. He just put out an HBO Max special called Live at SoFi Stadium. But what he also did yesterday was put out an album called Live at SoFi Stadium. And I think albums are a little bit more timeless than specials on a streaming service. What do we think about the biggest artist in the world putting out an album that has the name SoFi ingrained in the album, even if, you know, it's going to get hundreds of millions of streams, even if 0.0001% of those people just Google what is SoFi because they're curious because they see it on the Weeknd's album. Anthony Noto paid $625 million for 20 years for this, but he didn't pay for the Weeknd to literally put his company's name on an album that might be timeless one.
He literally is the largest artist in the world. In terms of Spotify, right now he has 60 million people that follow his channel and 102 plus million monthly listeners as the #1 artist in the world. And so they all got a notification, those 60 million of them, saying, hey, the Weeknd's new album is out live at SoFi Stadium. Does that translate into 60 million views for SoFi? No. The average person needs to see one advertisement 7 times before they click through onto it.
I think there's 2 things we should look at. Number 1 is the, let's say, depth, and number 2 is, let's say, the longevity. Right now, it's making a big boom because of where he is in his career right now, the Weeknd. And so that's obviously fantastic from a marketing perspective for SoFi because it's going to be on the tip of the tongue of everybody that listens to that album. I would say from a longevity perspective, live albums generally aren't as good as studio albums, but it'll all really depend in my mind from a longevity perspective on what are the tracks on that album and if one of them can be, you know, one of the iconic Weeknd tracks in the future. Because keep in mind, Abbey Road is what the Beatles' 2nd or 3rd biggest album ever, and then that's named after the recording studio. So they really depend on how good that album is and what the tracks are and how long those tracks stick.
Yeah, I want to highlight this comment by Jermaine. He says, we had the Super Bowl and NCAA National Championship there and it didn't do much for the stock. It's not supposed to do anything for the stock. It's supposed to create massive levels of brand awareness that get more and more people to know just about the company, SoFi. You know, those people are not going to invest in it. Most of them are not investors, but they will potentially sign up.
It's like insurance commercials, or insurance commercials like Geico, Progressive, and Liberty Mutual. They all advertise not because they think you're going to buy their insurance, but because whenever you need insurance one day, they want their company to be top of mind. So you go to their website first.
There's been some insane events at SoFi. Do you remember the pandemonia that happened over the Taylor Swift concert where tickets were going for like 5 digits for a single concert?
Chris, what do you think about SoFi and the live stadium and the album?
Of like the top 5 biggest artists in the world. So BTS had a concert there. Taylor Swift is having a concert there. The Weeknd had a concert there. And Bad Bunny, who, again, in Latin circles, he's like one of the most streamed persons in the world too. So he's like one of the top. The only one who hasn't is Drake that I know of. But like, I don't know, I think it's good for brand awareness. I do think that it's becoming kind of a go-to place. I think that it was good. I think it was good marketing, but I don't have the numbers, right? Like, and so it's really hard for me to speak to that. But the people who do, I mean, internally, whenever they talk about it, they say it's their best price per impression advertising they get. So I'm inclined to believe them. But I think it was probably a good deal just based on what I've heard, but I don't really have a strong opinion one way or the other.
Delinquencies as a total are rising, and
delinquencies are rising, but everybody knew that and they planned for it. Delinquencies across the industry are actually higher than they were pre-pandemic, but SoFi's are still pretty low. The SoFi
this is a killer chart, bro. I don't know how you argue against this chart. Like,
yeah, and the thing about this chart is, so it does have to do with FICO scores previous, like when the loan was originated, but those total amount of delinquencies still seem pretty low. Industry average is much higher than these, and so I wonder if this is just like the incremental, the amount more than it needed to be. 1% delinquencies on personal loans for Prime Plus is too low, I think, like in general.
Didn't they say in Q4 that their delinquencies were back to 2019 levels?
They're close. I mean, if you look at the 10Q or the 10K, we don't have their 2019 numbers because they weren't a public company and they don't disclose them.
That's what they were saying on the
It was
call,
better
though.
than 2020. Is that what they said? I missed that part.
Yeah, they said that we're with regards to delinquencies, they're back to 2019 levels, pre-pandemic levels.
Upstart said that they've been tracking delinquencies and they're higher than they were pre-pandemic across the industry. So I still think SoFi's outperforming, but
As you guys know, we talked about Nerdwallet, promoting that they gave SoFi seven different awards. Go Banking Rates gave it, the best online bank account. Yahoo Money just said that they were the best online lender. Fortune just said that they were the best online bank account.
They got the Fast
pulling up-
Company Most Innovative Award.
Aren't we tired of talking about how many awards SoFi gets? It's just tiring, right?
it's exhausting.
It's just been today. That's the Fortune magazine one that we ranked first on, but the Fast Company one, which I actually thought the reason why they gave us third was kind of weird. Like they gave
By the way,
Amex number one, and they said the reason why they're number one is because they've been going after millennials. But still, it still places SoFi higher up whenever you're putting in some sort of search result through Fast Company. Chris, you saw the 10K. Was there some eye-opening things?
I don't think that there was anything really eye-opening. I don't think that Q4 was as good as Q2 or Q3 for SoFi. I think that there's actually some cracks and some things that you can see starting to form that are trends that I'm not worried about SoFi long term, but these are things that I definitely want to keep an eye on. So the rising delinquencies is one. I actually think it's rising slow enough that it's still not that big of a concern to me, but it is something, again, to keep an eye on. The credit cards is the exact same thing. One thing that I think was interesting that Chris Lapointe addressed on KBW FinTech conference, whatever it was that he talked on, that I didn't know, and maybe you guys did, but he said that they have a hard cutoff at a FICO score of 680. So if you're below 680, they won't even give you a personal loan, which was something I was unaware of previously. But it's interesting because you look at that, and then you look at the average FICO on their credit cards, and the average FICO of their credit cards is actually below 680. So they're giving a bunch of credit cards to people that they wouldn't even consider for personal loans. And I think the reason behind that, and this is hard, the visibility isn't completely there, but when they became a bank is when their FICO score on their credit card started to tank. And when you become a bank, there's a thing called the Community Reinvestment Act. And so you actually have to give credit to local underserved people, basically. And so you have to extend credit to people who otherwise wouldn't have it. Just as part of being or having a national bank charter, they require you to do that. I think the way that they're extending that credit to these underserved communities is through their credit card. And so I think that's a mitigating factor. And the other thing is that it's like less than 1% of the loans that they give out. Like if you look at the total amount of credit card loans, like the total balances they carry on their credit cards, it's like less than 1% of like the sum of all of their credit. So it's not a big deal. Again, something to keep an eye on. It's mostly lost in the noise, right? Like it's not going to make or break SoFi. I guess the bigger things are, number one, I think that they're not selling loans at the rate that I would hope that they would have, which means that eventually they're going to run out of loans or be the ability to continue to originate loans. They'll be fine for the next 2, 3, 4 quarters, but if rates don't kind of stabilize and they don't figure this out, they might have some issues where they have to just pull back on their originations just because they don't have the capital to lend out anymore. Like their leverage ratios would go up too high. So that's something to keep an eye on. So the fact that they hedge against that makes a big difference. Because since the rates are going up, their non-interest income has been huge this last year because of those hedges. And it's something that's actually, in my mind, really differentiated them from Lending Club and from Upstart, is the fact that they're maintaining their fair value of their loans. So if you look at Upstart's earnings and you look at their fair values, they're just crumbling. And it's because they don't hedge, whereas SoFi does. The other thing that they do better than Lending Club is they actually stay ahead of the forward rate. If rates right now are 5%, but in 6 months they're going to be at 6%, then I'm going to wait 6 months and buy a loan then, because then I can get 1% better return on my money. And SoFi has stayed ahead of the curve. So they've actually been raising their rates that they charge on their personal loans faster than the Fed has been raising rates. Relative to every other fintech, they've been killing it, right? Like all these things that I'm talking about now that finally hit in Q4 for SoFi, we're hitting in Q1 and Q2 for everybody else. Affirm and Lending Club and Upstart and Coinbase and everybody else, like their revenues, Robinhood especially, right? Like all of their revenues are like down. Like they've got negative growth in a lot of those things. And they've got lots more delinquencies and they've got lots of other problems that SoFi hasn't seen, because I think SoFi's business model is better. But there are still things that are out of their control. that do affect things, and like it or not, right? That's part of the risk in investing in a public company.
Going back to the KWB conference, because I have notes here on that conference on Tuesday where Chris LaPointe was talking, he reiterated the macro assumptions that they have for where they expect the Fed to be. So I'll just read them out, and I'm kind of curious to hear your thoughts, Chris, as to that. Also, because of the term securitizations and the spreads were actually tighter than their last deal, which is signaling that it could, on a macro perspective, be, if their hypothesis is correct, better than they were expecting. Rates, they expect to reach 5% by mid 23 and 4.5% by end of year with 2 cuts. 5% cap on unemployment and to be more normalized. Obviously, unemployment is going to affect consumer businesses, so it's an important assumption to be making. Elevated credit spreads. So what I was just talking about, in January, they actually tightened, which is a tailwind for SoFi. Assume losses that are closer to 2019 levels, and assuming 2.5% GDP contraction by end of year. These were Chris LaPointe's assumptions, or SoFi's assumptions, that he reiterated at the KWB conference. So I'm just want to get sort of a pulse on how do we feel about those macro assumptions, because if those are off, then everything that trickles down from those is going to be off as well.
From what I saw, that banks are also making similar bets in terms of 2 hikes, 2 cuts this year. I think they're kind of following course. I don't think it's that far out from the norm.
So I think at the time, I think that's what everybody was. So if you look at like the CME group, they're the ones who put out, they have a website where they say what are the probabilities that we have different Fed funds rate based on kind of what the market thinks and what they think. And they were predicting basically the exact same thing that SoFi put out in their guide. And if you looked at like the 2-year treasury yield and the 10-year, they were kind of following that same trend where, the market was at that point. But since then, they've gone back up, right? So now the higher for longer narrative has kind of taken over. People think it's going to get above 5 and probably not coming down the rest of the year. 5% unemployment seems like it would be a deeper recession than 2.5% contraction. The one to me that affects SoFi most is the unemployment, because the reason that people default on their loans is if they don't have income to cover it, right? So SoFi originates to free cash flow. The only way that free cash flow goes down is if people get laid off, right? Not the only way, but the predominant way. And that's also the one that to me seems the most conservative. Like a 5% unemployment rate from where we are right now is a huge jump, right? We're at all-time lows. It's crazy. It's never been this low. Like, it's insane. It's like one of the lowest in the US. But the unemployment rate across the US is the lowest it's been in like 50 years.
So the unemployment numbers are based on people who are looking for work. So it's not just all unemployed people. People can just quit their job and not look for work, and then that's not considered an unemployed statistic. So it's actively looking for work. But yeah, go ahead.
A lot of people just left the workforce, right? They were close to retirement anyway. They left the workforce. They just decided not to come back.
Those people wouldn't reflect at all
on the unemployment numbers, right? So if you look at absolute, it's been a couple months since I looked at it, but if you look at the absolute number of employed people, even though unemployment was like way lower, we weren't back to the same number of jobs that we had before the pandemic, because a lot of people just left the workforce. You look at the layoffs that have happened in the tech sector, and the tech sector is in a recession. You look at their earnings, you look at their unemployment, you look at everything. Like, fintech's valuations have been hurt worse than I think almost any other sector. The tech sector has been down, but despite the fact that these people have laid off hundreds of thousands of workers, the unemployment is still at a minimum. But the interesting thing is that like wages are down, which means that these people who are getting laid off from, I don't know how much they make, $300,000 jobs, now there's a bunch of people who are entering the workforce, but they're not making $300,000. Maybe some of those people are starting to get new jobs, but in general, right, the averages show that people who are getting laid off are making more than the people who are being hired, even though like the jobs numbers are really healthy and that we're adding a bunch of jobs. They are lower paying jobs in general.
What that would mean for SoFi, because they have such an aggressive cap in terms of earning as well as FICO, is as the fat is trimmed, so to speak, in terms of the wage inflation that had been happening for so long, due to the fact that, especially in the tech sector, like Chris was saying, we're in a drawdown, it would be much harder for SoFi to gain more clients that fall within that threshold. So presumably, the longer this draws out, the more SoFi is going to be strained to maintain those same numbers in terms of member growth for loans, and or having to lower that threshold, reduce the limitations, let's say, in terms of their average earnings and in terms of their FICO, which inherently increases their risk. And we come full circle to this delinquency conversation.
I think the bigger issue is just kind of what Tevis has said. I think it's just the slowing growth, right? Like if SoFi were only to grow 10% next year, right, we're looking at a stock that's going to be trading at 4 or less. It's a growth story, right? And if the growth story dies, this is what's kind of happened to Palantir, right? Is the fact that they've been saying, hey, we're going to be growing 30% for the next 5 years. And now their guide came out and it's much lower than that. And so people are worried, is the growth story over? Is it just macro conditions that are hurting it? And so the same thing's true with SoFi, right? If they start pulling back, and I guess to your other point, Tevis, I don't think that they're going to lower their underwriting standards. Everything that I've heard from management says we'd rather pull back on lending than drop our standards, and you're seeing that, right? So in the fourth quarter, their origination shrunk by like 10%. That's the first time SoFi has ever decreased their originations in personal loans, like since they became public.
Whenever we're actually looking at the tech platform, not only is it staying flat, whenever we actually break that down into the different actual payments, software licenses pretty much only falls under the Technisys. And then there's also the actual technology services, which is mostly both Galileo and Technisys, but that's actually dropping. It's not even staying flat. It's dropping dramatically.
I think the explanation is that neobanks are suffering. If you look at the people who are hurting in this macro environment, it's the people who are living paycheck to paycheck and who can't get by. They no longer have any discretionary. Like the people that are being left behind by inflation are the people who can't pay for groceries. And those are the type of people who most of these new neobanks are actually trying to service, right? A lot of these neobanks are their clientele are the underbanked, the underprivileged, Chime and Dave and MoneyLion and all those are all Galileo clients, right? And the people they service are these people, and these people don't have they're not using the debit card as much. They aren't spending as much as they used to. And they're tightening their belts because they have to. And those are the people who are being left behind in the current economy, and who, life is really hard for them right now. The macro environment is affecting the tech platform way more than it's affecting the bank. Yeah. And that's why we're seeing like that. It's a big headwind for Galileo.
Also, Chris Lapointe, again on the KWB FinTech Fireside Chat, did talk about the tech platform, how, I mean, they mentioned in the Q4 earnings, and I guess he reiterated the fact that SoFi is deliberately now going after larger, more durable companies, even in spite of the fact that these companies have longer sales cycles. So the average, let's say, deal to close time is much longer with, a large major financial institution to sign on with Galileo as opposed to a small neobank. Regardless of that, they're still going because the revenue is more durable and more long-term in this type of macro environment. So that's number one. And then number two is the fact that he mentioned in the KWB conference that in the medium term, margins will expand to historical levels. Margins for the tech platform were something like 24% in Q4. Historical levels are something in the mid to high 30% range. We might see some type of diversion or duality, discrepancy between the consumer business, where SoFi is going to weather the storm much better because of the fact that they have higher end clientele that is going to be disproportionately hurt compared to, let's say, Chime's user base or Dave's user base. Whereas Galileo is going to have a harder time because they are servicing these neobanks that are struggling. But now that they're pivoting their strategy to more longer term, durable, big established names, Chris Lapointe basically reiterated that the margins would come back to historical levels by the end of the year.
Yeah, and I couldn't have said it better, Tevis. So that was a great point. Like I think this is a reason why they're diversifying, right? They're trying to get these bigger platforms and bigger companies into the tech side, because they do need to diversify that. Right? I think they've seen in the numbers, right, that neobanks are kind of struggling, and they want to, the same way that they want to have a resilient client base from the consumer business, they want to have a resilient client base on their business on the B2B side.
I've been following SoFi's hiring listings, and in January they're trying to hire a senior director for the credit card product, which is something that we never saw in 2022, because they weren't hiring anything for their app, like front end. So we know for a fact that they're working on their front end credit card offerings, maybe different newer credit cards coming to the app maybe in 2024. And then also just this month, it's one of the links in our private chat here. They're hiring a senior director for their invest platform. So it looks like they're actually starting to focus on building out a better invest platform. We also had a leak in January of like what that might look like.
Be careful with how you're watching the headcount growth, because it doesn't necessarily mean that anything new is going to come out. Like,
Yeah.
look at the amount of people that work for DocuSign and then use their products day to day and tell me if anything's changed.
Well, to your point, Tannor, they did cut a bunch of people. I mean, I think it was like 5% or something, but still, it was a cut off of the tech platform side of the business. And they mentioned that their biggest focus in 2022 was the migration from on-prem into cloud, which presumably would reflect in our financials this year, as it's going to have cost savings, which contribute to the margin of the tech platform, along with those cuts. So it's not always a one-to-one relationship that the hiring is going to lead to products. You know, you could also have the margin expansion that comes from cuts, and it comes from, you know, the streamlining of redundancies.
Their on-premises stuff, they said they're going to get rid of it in 2023, right? So they've had this redundancy where everything can function in the cloud and everything can function on-prem, and they're cutting that. And I guess to your point, Riley, Chris Lapointe actually did point out. He said we think that the invest product has a lot of room to grow this year, and so I do expect that they'll continue to. So they offered options. I think that they'll lean into that. I hope that they'll release a new UI, but it is something that it's not just us speculating here. Like Chris actually called it out and said that's a vertical that we can still exploit this year.
Our technology services, which is a mixture of both Galileo and Technisys, actually dropped off this quarter for the first time in
Sorry,
SoFi's history.
What is this, revenue?
This is revenue.
Correct. Yeah. Whenever we look at software licenses, I don't know why this large bump. This could be just a simple Q4 thing, potentially. Like we don't have the numbers because we didn't have Technisys back then. Maybe it's a similarity, but this is actually what made quarter over quarter still look kind of flat. But whenever you just look at this top line, it's like, okay, well, is this going to go back down to this, in Q1? So I don't know if this is a cyclical thing, if this is an end of year payments for most of their clients, or if we maybe closed a massive deal. If we did close a massive deal, awesome. If it's cyclical, scary.
Yeah, I don't know. I wouldn't call them red flags, but I definitely call them yellow flags, right? Like there's nothing in here that it's like, oh, this is a big deal. But there's lots of things in here. This is something we've definitely got to keep an eye on. To me,
I think this is a big deal. Like I know that this down from this is not a big deal, but if you're going to try to continue to talk about year over year growth rates and you stay flat, those year over year growth rates are going to quickly head to zero. You know what I mean? So right now it's still like, hey, we grew 31%, but by the time Q3 or Q2 of 2023 starts coming around, it's not going to look so great.
Yeah, agreed completely. And that's why, again, it's the slowing growth that I'm worried about, and especially the tech platform. And the other thing that's hard about the tech platform is that there's not very much visibility. Even if you pour through the 10Q or the 10K, with lending especially, right, there's a lot of things that they disclose, and there's a lot of things that you can follow and look at. I have a much harder time prognosticating on what's going to happen with the tech platform. There's just not enough visibility for me, and I'm not in the space.
There's even less visibility now that they don't have to disclose their customers in the 10K in 2021.
Which is actually a good thing that they've diversified their client base,
yeah.
Therefore they don't need to disclose it. But now we don't actually know who the big clients are.
Yeah. So for context, Lapointe mentioned this on Tuesday, and it was also in their 10K. The fact that in 2021, their top 5 technology platform customers accounted for over 60% of the technology platform revenue. Whereas in the 10K that we saw this week, they're not disclosing any concentration for the technology platform customers, as they don't have to disclose it, as no single customer on the platform accounts for more than 10% of total technology platform revenue. So it's a point on diversification to say that all of our clients are under 10% of our total revenue. Obviously, that's a good thing from a risk perspective because you're not putting all of your eggs in one proverbial basket. But from a visibility perspective, it doesn't help our case.
SoFi Peacock promotion, that's kind of cool. It's not something to chew on forever, but if you sign up for SoFi's credit score offering, you get 3 months of Peacock streaming services. Out of all the things that they could have advertised with this promotion, they did the credit score, because I guess it doesn't seem like that much of a risk. Like people would be like, oh, just this credit score app that's free. They'll download SoFi, and then SoFi will try to cross-sell them and get them.
So that means SoFi is paying the $30 a month or whatever.
Yeah, you can pull up the
30
link. It's in that private chat.
Okay.
But, see, I don't know. We don't know.
Yeah, we don't. That's stuff we wouldn't know.
I think it's $5 a month for Peacock subscription. So, like, let's say SoFi actually foots the bill. They're paying $15 for customer acquisition.
Not bad.
Which not bad. And then also, I guess it just seems like win-win.
It's so
Smart.
weird. Like, why Peacock of all the streaming services?
No,
it's like
bro, The
a
Office is on
useless one.
Peacock. There's a lot. I mean, Comcast owns a lot of it. NBC, CNBC, all that stuff on Peacock.
Honestly,
Dude, when was the last time you heard someone talk about their Peacock subscription, as opposed to like even Hulu? I would imagine is like way more than Peacock.
legitimately never.
I think
Exactly.
SoFi chose them because it's probably good unit economics. Like Netflix would probably demand more from SoFi,
See, that's the thing where I think SoFi wants to be. We always talk about them being a very affluent client, but I really don't think that's what they want to be long term. Like, I think if they were really trying to step up and get a really affluent client, they'd do like a Sirius XM subscription, promotion or something along these lines. Peacock is like the complete opposite. I think that's like a budget streaming service. It's like promotes a more average clientele, or even I don't know who uses Peacock, but $5 a month doesn't sound like a lot.
It's a good opportunity for Peacock as well to gain customers. The deals are mutually beneficial for both companies. So from that perspective, Peacock has more skin in the game than Netflix would for this partnership, because it's mutually beneficial for both parties.
Yeah,
What do you
we
think
don't
of
know what the customer acquisition cost is. But it also doesn't mean that we can acquire like that. That's the weird thing whenever we look at customer acquisition costs or something like this. It doesn't mean that customer acquisition costs can't go up after we've acquired the customer. For example, we could acquire the customer and pay their 3 months of Peacock or whatever, or maybe if it's even less than that, but we'll still maybe offer them the $250 to sign up for direct deposit. That offering is still customer acquisition cost. You're still,
And they'll pay it back in 12 to 24 months. I think that's what Chris Lapointe said on Tuesday. He said that the financial services, it takes about 12 to 24 months for them to pay off their CAC.
The more I think about this, the more I think it's really genius. Because, Chris, I don't know if you check your credit score through the SoFi app. It's actually pretty good. With Credit Karma and Experian, you try to download those apps to like keep track of your credit score, and it's just ads for like upgrading your stuff. And there's just all this bloat because they're trying to add value, but there's not a lot to do because all they have is the credit score. SoFi just makes it very simple, and it only shows you the very specific things. But also, if you become a SoFi member, every time your credit score goes up, you get SoFi rewards. So as soon as like somebody wants to get this like 3-month promotion and they download the credit score app and they check it for the second time, SoFi is like, hey, your credit score went up. Do you want like free money? All you have to do is just sign up with our bank, because every time your credit score goes up, we're going to give you SoFi reward points. So I don't know. This is cool. Like, this is a cool mousetrap. Chris, thank you for coming on and
My pleasure.
and diving on the 10K. Appreciate it.
Talk to
Thanks,
you all.
everybody.
See you next week. Thank you all for joining. Bye-bye.
Bye.